it's not looking good going into the summer. There's a little blurb that I wrote here. There's a particular risk around Mexico's economy in the United States that could make goods inflation go significantly higher. But I'm going to read this section here because I feel like I still need to do more research on this thesis around Mexico's economy. So this risk around Mexico, in conjunction with risks of higher US manufacturing goods prices. The reason why manufacturing PMI in the US jumped is because more manufacturers were passing on their goods prices to consumers. That's inflationary. And consumer inflation also rose. The summer of 2024 could see another bout of US inflation reaccelerated from the price of goods instead of services. And if services still remain sticky going into the summer, as goods inflation begins to reaccelerate, I would not be surprised sometime towards the end of May for central bankers to start getting more hawkish in their commentary, explicitly saying, hey, we might need to do another rate hike here because these prices are now still getting out of control. It doesn't seem like monetary policy is kind of managing this well. And imagine the Forex market's condition on US dollar strength if all these central banks are still cutting or holding at their current rate while the Fed is threatening another hike. I mean, that's probably going to bring you down. All these Fed rate features that do the probabilities for how many cuts we're going to get. If that situation occurs with the Fed threatening another rate hike going to the summer on higher goods inflation and stickier shelter and energy inflation, we'll probably end up with like a 50-50 probability of one rate cut or a 50 basis point rate cut like in December, or we'll start to see more rate cuts getting pushed out into the first quarter of 2025. Yeah. Big.